Welcome back. We're jumping right in today with a technical analysis report on Strive Inc., that's ASST, which argues a recent 9% gain means the stock is just getting started on a major run thanks to its correlation with Bitcoin.
Yeah, this one is very high conviction. It's laser focused on justifying a big target, 150 plus, using just momentum. So our feedback is really about making that case as solid as it can possibly be.
Okay, so let's start right there with the fuel for this whole idea, the Bitcoin connection. The analysis report makes a pretty strong observation that ASST is acting like a high beta crypto play.
It does.
The theory's compelling, right? Bitcoin moves 1%, ASST moves 5 or 10 because it's this little micro cap trying to catch up.
And integrating the foundational logic behind why it's a Bitcoin beta play is really essential to make that correlation feel robust and not just, speculative.
Right.
The report's correct in what it sees. The effect is there, but it leans very heavily on that lagging relationship without actually grounding why ASST structurally functions as a Bitcoin treasury play.
Okay, but I wonder, for a pure momentum report, is it fair to demand fundamentals? I mean, the focus here is clearly on the charts, the short-term narrative. They're trying to avoid a deep dive.
I get that, but the issue isn't really about depth, it's about vulnerability. See, when your whole thesis is pinned to an asset like Bitcoin, that link has to be solid, especially in a microcap where things can change in an instant. If the person reading this can't confirm why that link exists, the whole argument is at risk. The second that correlation hiccups, confidence in that 150 target it evaporates. It starts to look like coincidence, not a real structural relationship.
That makes sense. The trade falls apart the second the market asks why. So we need to bridge that gap between the technicals and the fundamentals, but quickly.
Precisely. So the suggestion here is just to bolster that fuel section. Briefly establish the link between Strive and crypto, just to confirm the beta play is intentional, not just, market noise. It's about building credibility.
Okay, so how brief are we talking? Give me a concrete way to do this without turning it into a balance sheet review.
It can be a single sentence, just one surgical line. For instance, add something that confirms the company's actual exposure.
Like what?
You could say, the company recently confirmed holding X% of its treasury in BTC. Or even, ASST's primary revenue stream is derived from activities correlated with crypto miner performance.
Ah, that's really effective. That shifts the argument from, it acts like a crypto stock, to it is a crypto stock. That one little piece of confirmation gives the whole thesis a floor.
Exactly. And look, if that data is genuinely hard to find, which for microcaps it often is, then you have to address that directly.
So you just acknowledge the gap.
Yeah, just revise the framing. You could say something like, the correlation is empirical for now, but it needs a catalyst, like a company announcement, to be fully solidified. That shows you're being honest. It manages expectations, and it keeps the report's voice authoritative.
Okay, that makes a lot of sense. So let's pivot from the structural fuel to the safety measures. The analysis calls this high risk, high reward, and note sentiment is extreme greed. It's got support at 82 cents and downside to 75.
Right. And to align the report with that high-risk profile, it needs to more explicitly link those identified risks to the key technical levels.
I think right now the risk assessment is sort of separate, right? It's in the summary, and the focus is really on the upside targets, 90 cents, $1, $1.50.
And that separation is a critical flaw in a fast-moving trade. When risk is decoupled from your actionable levels, it just becomes an intellectual warning, not an immediate instruction. Side note, it has to be the immediate obstacle the stock has to clear.
So the real weakness, then, is that the analysis defines the prize, but it doesn't rigorously define what makes the thesis fail. How do we shift that emphasis?
You have to frame the support levels not just as places where the stock might bounce, but as critical checkpoints that if they break, the entire bullish idea is negated immediately.
So the floor isn't where it might find a bid. It's the specific point where the just getting started thesis actually dies.
Exactly. And I know some might think that's too aggressive.
Yeah, I was going to say, does that kind of framing the thesis dies scare off the momentum traders this is aimed at? They like risk.
But they thrive on discipline, on having predefined exits. By defining the failure point that explicitly, you're actually empowering them. You're giving them the non-negotiable line in the sand. A softer approach just leads to hesitation. And in a high beta trade, that's where you lose serious money.
That's a very strong case for discipline. Okay, so give us some concrete examples. How do we weave this urgency into the technical levels?
Okay, so when you discuss the immediate support at 82 cents, you tie a break of that level to the psychological impact. Don't just note the level.
So you say,
You say something like, a close below 82 cents does more than just break a technical floor. It validates the high-risk warning and likely forces liquidation from short-term traders, which then accelerates the move down to the 75-cent floor. You're defining the consequence. 82 cents becomes a battleground.
that turns a static price into a real dynamic trigger.
It has to be, and then in the call to action, you define the failure of the thesis just as clearly as you define the trigger for the upside.
So not just what makes it work, but what makes it fail.
Right. For instance, if 90 cents is not cracked within 48 hours on heavy volume, the breakout attempt is likely stalling. You're telling the person reading that this has now become a holding risk instead of a momentum opportunity. It adds a time limit. The thesis isn't just about price, it's about time.
A time limit on the thesis itself. That's a powerful shift. Okay, let's move to the third pillar here, the core technical confirmation, volume. The report says volume precedes price. The big money is stepping in.
And that core technical argument requires stronger, quantified confirmation of that volume profile to really validate the conviction behind that statement.
I can see the issue already. The observation on the 9% move is a bit soft. It says the breakout was likely accompanied by higher than average volume, which is just implied by the candle.
And that one word, likely, is fatal in a technical breakout report. Volume is the hard evidence. It's what separates a real breakout from a fakeout, a temporary spike.
Right.
When you're calling for targets like 90 cents and $1 because big money is stepping in, you have to prove that money is actually there. You can't just assume it. That assumption undermines the whole call.
But why does that one word, likely, do so much damage for a sophisticated technical person?
Because technical analysis is supposed to be about data points. It's math, not a feeling. If volume confirms the move, the thesis is valid. If volume is just implied, the thesis is a hunch. It might be a good hunch, but professionals commit capital based on proof, especially in a microcap where liquidity can just vanish. We have to replace that implication with specific, confirmed, contextualized data.
This is where that rigor really counts. But what about timeliness? Is there a risk that waiting for volume confirmation makes the report too late for a momentum trade?
The risk of not quantifying it is far, far greater. A false breakout on low volume can be a disaster. We're not talking about waiting for a news release. This is about basic confirmation of the day's move. It should be part of the initial data gathering.
Okay, fair point. So how do we integrate this data cleanly so it gives context to the move?
It's simple. You provide a clear quantification of the volume increase versus its history, its objective, and it instantly validates the premise.
Give me an example.
A concrete example would be, the breakout volume registered at 7.2 million shares, representing a 310% increase over the 50-day average, confirming institutional participation. That number is definitive. It speaks for itself.
And then you tie that hard metric into the key levels to watch section.
You have to. Volume becomes a prerequisite for validation. For example, you modify the 90-cent breakout line. It shouldn't just be once it cracks 90 cents.
It should be.
Refine it. Once it cracks 90 cents on confirmed volume exceeding 5 million shares, the path to $1 is thin. See? Now you're giving truly disciplined, actionable guidance. You're ensuring they only chase breakouts that have real institutional support behind them.
Okay,